Hello, scholars. My name is Joseph Ejike Oji, and I'm going to keep you company this early morning. The topic of our discussion, the topic of this lecture is the Black-Scholes Model. Black-Scholes Model is the model for pricing option, especially call options. Many option traders use it a lot. So what exactly is the Black-Scholes model? Give me a minute. I'll explain in a minute. I want to make sure you're seeing this. Okay, good. So the Black-Scholes model was actually developed by three economists: Fischer Black, Myron Scholes, and Robert Merton. So from Fischer Black and Myron Scholes, that's where it derived its name. So Black-Scholes model is actually the world's most well-known option pricing model. It is used to calculate the theoretical price of the European put and call options. And while doing that, you ignore any dividend paid during the option's lifetime. So it's widely used by option traders. Now remember, they say European option or European call option or European put options. Actually, these names are it doesn't, when they say European, it doesn't mean that it is only for the Europeans. It's just a way of describing, I would say, the kind of transaction that is done. So for European option, the transaction is you have to wait. You don't exercise the option until the expiry date. But for American option, you can exercise it anytime. So those terms are just used to describe the type of transaction done. Now, there are some basic assumptions of the Black-Scholes model. The first one is that the option are European, okay, and can only be exercised at expiration. So when it expires, that's the only way you exercise it. So Black-Scholes assumed that the options, both the call option and the put option, are European option. The second assumption is that no dividend are paid out during the life of the option. Then number three is that it assumes that the market is efficient. So that is when you say the market is efficient, it means that market movement cannot be predicted. Okay. All right, let's see. So the next assumption is that there's no commission. And the fifth one is that the risk-free rate and volatility of the underlying assets are known and they are constant. So the risk-free rate and volatility, we use the standard deviation as a measure of the risk of volatility. Then the last assumption is that it follows a lognormal distribution, which means that the returns on the underlying assets are normally distributed. Now, I'm sure that by now you'll be asking yourself, what do I mean by the underlying assets? Well, the underlying asset is the asset that the option is based on. So option can be based on stock, can be based on currency, it can even be based on commodity like oil. So those are the underlying, that's where in those three things that I mentioned, in which the option derive their value, we call them the underlying assets. Now, at this point, we're ready to look at the Black-Scholes formula of valuing options. So the formula is this: value of the call option VC is P times ND1 minus, in parentheses, X over E to the power R times T times ND2. Now, the formula I know it looks like a monster. So anyway, but when you start using it, you see that it is actually easy. Besides, we put the formula in Excel, and then it makes it even more easy. Now let's look at the parts of the formula. V represents the value of the call option. P represents the current price of the call option. Actually, the current stock price, not the current stock price as P represent. Okay. Okay. Stock price. Okay. That's what P represent. Now, remember the stock price is in this case, I will say the price of the underlying assets. And this simply means the cumulative normal probability density function. Basically, what it is saying that it represents the probability that a deviation that is less than D will occur in a standard normal distribution. So, but that is the general concept. However, what we are looking at is the ND1 and ND2. So they're both generated from the ND. So ND1 simply means the probability that the price of the stock will change sufficiently to provide a payoff. And ND2 means the probability that the option will be exercised. Then X, this X here is the strike price. That means the price of the stock of the option. So we are left with E and RT. Now, the E, let's look at the T. T just means the time for when the option will be exercised. That's the expiry time date. So the time to exercise the option. When I mean exercise, it's either to buy or sell the option. So if for example, there are 12 months in a year. So if the time is if the option is exercised in 3 months, so the time will be 3 out of the 12 months, which is 0.25. R is the risk-free rate. We can get the risk-free rate from the value of the yield of a treasury bond. Now we say that it is risk-free because we base it on the US treasury bond. That because US have never defaulted their bond, we assume that it's risk-free. Now, let me show you what I mean by those information. Like you can get so many of them. We discuss that as we proceed. Now, E is the natural logarithm. It's a constant, and this value is 2.7182. Now, this natural logarithm, you can get it directly from Excel. All you have to do is to type. Remember, when you want to get something from Excel or do any calculation, you need to put equal sign first to get the cell ready. So for the natural logarithm, just type exp, opening parentheses, you can see that it is here. It shows, put 1, and that will give you the value. Press the enter key, you can see that 2.71828. So it's very easy to get. I said it's a constant. Then next thing we look at is the standard deviation, which is it represents the standard deviation of the returns. Now you can calculate those returns of the stock that is underlying assets, which is the underlying asset, by going to Yahoo Finance. For example, if you go to Yahoo Finance, let's say that the stock we are using is Disney stock. Let's say it's Disney stock, or we can even use Nvidia stock. Nvidia. Okay. My computer is a little bit slow, but let's see. Nvidia is a tech company. See the stock $425 per share. We can use that. So you can look at to get the return. You can click on the historical data. That will give you the prices, weekly or daily prices, and then from there you can calculate the return on the stocks. You can see where my hand is, the historical data. It's just that the system is a little bit slow. It will bring it up in a minute. So you can see the prices over there. You can see the opening price, high for the day, low for the day, and closing. You can use the adjusted closing. I normally use adjusted closing price because it's already factored in any dividends. But option, remember, we assume that there's no dividend, but it's still going to give us the better results. So you can calculate that, use that to calculate the standard, to calculate the return. You can use these values to calculate the return, then calculate the standard deviation from that. Now, remember, part of the formula we get is ND1 and ND2. To find ND1 and ND2, first of all, you must find the D1 and D2. And the formula for D1 and D2, you can see right here. For D1, the formula is log P over X plus R plus S square. S square means variance over 2 times T over S times root T. So that will give you a D1. You plot the numbers that I just described. Now, there is a secret I use when I encounter some of these complicated formulas. All you have to do is to do the parts of the formulas separate. That means you can do this part separate, do this part separate, do this one separate, then combine them to get your answer. It makes your life easy. Now D2 is D1 minus S root T. I'll give you D2. With that, you can now get your D1, D2. Before we proceed, there are some few things we need to know about Black-Scholes model. Excuse me. So the first thing is that the formula, why it is complicated, actually requires readily available input data, with the exception of the standard deviation. So that what means that the data you put there is already available for you. For example, the values for P, which is the stop price, X, the strike price, and T can be obtained from any newspaper that have a business section, or even from Wall Street Journal, or from the internet. Let me show you from the internet where you can get P, S, and T. Again, I'll take you to Yahoo Finance, and we are using NVIDIA. NVIDIA, like I said, I think it's a pharmaceutical company. Let me see. Give me 1 minute. I'm gonna get the company profile. Yeah, NVIDIA. Yeah, it provides graphics and computes and networking solutions. Okay. The company, okay, graphics. Okay, it had to do with IT. Good. It's an IT company. So back to what I want to show you. Remember, what I wanted to show you is that the inputs, the values you're going to use for the formula are already there. For P, which is stop price, which is considered can be the current price of the stock option, of the call option. I would say the stock price, because the option derives a value from that price. So then X is from that option derives a value from that stock. S is the exercise price, and T is the time. So if you go to that Yahoo Finance, where we have NVIDIA, if you click on the section that says options, it will open up. If you open this up, and you can see we have different call options, different contracts. Let's look at the first one, which is the contract. I'm going to click on it, and it will open up. My computer is slow today. Now you can see the price of the stock already. Now the strike price. Look at the strike price here, $70. You see the strike price X. Then the time to expire. It expires on the 11th, which is tomorrow. So you have the T, and the stock price is $358.05. This is the strike price and the time. So I got trade value from here. Now, for the parts that involve the risk-free rate, risk-free rate is you can also get it from here. The return on the treasury bonds So if I go to, I click on Yahoo Finance, the home page, you will see the returns of various, this computer, I don't know why it's slow today. See the return of various indices, but the one we're looking for is return on the treasury bond. 10-year bond is more, you can use that. For, well, because the market have not closed, I mean, haven't opened yet, so you won't see anything here. You can only see 0, 0, 0, but once the market opens, you see the return. But look at this last return here, 4.012. Okay. Now, I'll give you the risk-free rate. So all those inputs are already available for you. Okay. Then the standard deviation, of course, I showed you already how to calculate it in my previous lectures. You can get it by going to the stock, the underlying asset itself, which is NVIDIA. We're using NVIDIA, and then this, you can, when you go there, you can look at the historical data. That is the various prices over a period of time. You can use them to calculate the return and then calculate the standard deviation of that return. It's a measure of risk. The standard deviation is a measure of risk. Okay. So that is, these are the things we need to know about the option. Now let's get to work. First question, which is question number 1. I hope you can see it. Yep. It says you are evaluating a call option. Which is it says you are evaluating a call option which has a $20 exercise price and sells for $1.60. It has a 3 months to expiration. The underlying stock price is also $20. And its variance is 0.16. The risk-free rate is 12%. Calculate the value of the option. So look at the values we are given. We are given these values. Strike price, exercise price is $20. Current stock price is $20. Option premium, which we don't use that in the calculation, but we use it to compare our answer and make, decision or analysis based on that. Then variance is 0.16. Okay. Yeah, variance is 0.16. And our time to expiration is 3 months, which is 3 over 12. That'll give you 0.25. Yeah. So risk-free rate is 12%, which is 0.12. So note, so this is what we need to calculate it. And we're going to plug all this into the formula. Before we continue, I would like you to remind you that the risk-free rate means the rate of return that can be obtained from a risk-free investment like the government bonds or similar low-risk securities. In US, we use the treasury bond as a risk-free rate. So the risk-free rate is used in the model because it represents the opportunity cost of tying up fund in an option instead of a risk-free investment. So now, the higher the risk-free rate, the more valuable it becomes to hold an option that provide the potential for the future gains. Now, having seen this question, and they give us all these things to calculate the option value. To calculate the option value, there are 3 things we need to do. First thing is to calculate the D1 and D2. Second thing is to calculate the ND1 and ND2. Third thing is to calculate the value of the call option using this formula here. I think I mentioned this a few minutes ago. I like to separate the formulas, get the separate part of the formulas, get this part separate, get this separate, get this separate, then combine all of them to get a final answer. Remember that each of these steps require multiple steps. Okay. Now, let us begin. Remember, we are giving all these values. Let's start putting them on the table. Now, remember, it says here that the call option has a $20 strike price, and it also says that the stock price is 20. This is just coincidence. They're not always the same price. Okay, anyway, let's begin. I will begin by putting the values they give us first. Okay. Now let's go to Excel and put them in. See that the stock price, current price of stock option is $20. Okay, and the exercise price, according to the question, the exercise price X is $20 as well. Okay, so I'm gonna put it there. $20. $20. Remember, these are currencies, so I'm gonna put it here. So, like I told you, I'm gonna do this part of the formula separate. Like I'm gonna do this part now. This part now. Because our first duty, our first job here is to find the D1 and D2. And these are the D1 and D2 formula. So for this D1 formula is more complicated. So I'm going to get this part separate. Get this part separate. Get this part separate. Then combine them. So because I'm getting this, getting this part, I'm going to start from here. P over X will be equal, P is right here, divided by X, which is this one here, the strike price. Then press the enter key, that gives us 1. Then log P over S, you can see right here, log P over X equals type log. Okay, it will show up. Double click on it. P over S is right here. Get the answer right here for P over X. And that gives us 0. Risk-free rate. According to the question, the risk-free rate is 12%. 12%, when you change it to decimal, it's 0.12. So I'm going to put 12% here, 0.12. Excuse me, 12. Then the variance, to give us the variance. Let me see. Variance is, according to this question, variance is giving us 0.16. 0.16. So I'm going to put 0.16 right there. Okay, 0.16. Standard deviation is always the square root of variance. We know that from their statistics class. So I'm going to find the square root. The Excel formula for square root is put equal sign, type SQRT as the square root for Excel. Double click and then click on that variance. The square root of the variance gives us the standard deviation. Press the enter key. Yeah. Now, time to duration, time to expire. Just this T. According to the question, we have that T. It has 3 months to expiration. So T is 3 out of 12 months. So it's gonna be equals 3 divided by 12 months. Okay, 0.25. Now, square root of this square root of T, I'm gonna get it here. Root T, because I want to like I said, I separate the part of the formula, get the separate parts, then combine them. So square root of T, remember that this is the T right here. Square root will be now equal SQRT. It pops up. Double click, click on the T, close the parentheses, and press the enter key. Give you 0.5. Then this part S times through T. I'm gonna get it now. Equal our S standard deviation is right here. 0.4 times root T, which is right here. It's the square root of root T. Right here. Yeah, this is root T right here. Okay. 0.2. This is S times root T. T174. Okay, good. Now it's time to get this part of the formula. I've already gotten this one, and it is here. I've gotten this one and this right here. It's time to get this part. So to get this part, let me get this one in parentheses first. Equals R plus S squared over 2. S squared means the variance. So I'm going to put parentheses. Our R, which is risk-free rate, is 0.12 plus, okay, parentheses, the variance, which is S squared, is right here. Okay, over 2, and then close the parentheses. Remember, you have 2 opening parentheses, so you have to add 2 closing parentheses. So I'm going to close it twice to balance it. That give me this result. Okay. Now I can now say, I've gotten the one in parentheses. Let me get the one, combine them to get the whole of this part. I got equals, we have R plus S squared over 2 times T. This is this answer right here. Gonna be this, okay, times T. And our T is, what's our time, is 0.25 right here. Okay. That gives us that part. So we have gotten this part, I've gotten this part, I've gotten this part. So to find the D1, our D1 now become equals parentheses log of P over X, which I got here as 0, plus R plus I squared over 2 times T, which I got the answer here as this, close the parentheses, divided by S times root T, which is this one here, S times root T. So I press the enter key. That will give me the value for D1. Okay, D1. That's 1 minute. Just double confirm it. Yep, you can see the D1. I got D1 as 0.25 in this here. Remember that D1 represents is the term that we use to estimate the probability that the option will expire in the money. We said in my previous lecture, I explained that when the option expires in the money, it means that it will be profitable to the holder. So D1 is the probability that the option will expire in the money. Here is 0.25, which is 25% chance that it's going to do that. So we get our D1, okay, as this, 0.25. So make it 0.25. I'm gonna use different colors to highlight several parts of this. Okay, let's get to D2. D2 is right here, is D1 minus S times root T. So equals D1 is here minus S times root T. We got it here as 0.2. That gives us D2. I can use it, this, a different, maybe little green. So D1, D2. Okay. Now, I will make sure that I want to make sure that I didn't type anything wrong in the my PowerPoint. You can see that our D1 is right here too. See, D1 is 0.05, which is the same thing we got, excuse me, in the Excel. So, and remember that this D1 this D2 represents the probability that the option, that the price of the option will change sufficiently to provide the payoff. That's for D1. Okay. Now, excuse me. That is for D1. Now, but the D2 is one we're interested in. D2 simply means the chance that the price of the stock will change sufficiently to, I would say, put it that way, to generate a payoff. Now, give me 1 minute. Let me look at the double check my D1 again, because my D1 is is 0.25. Good. Now, okay, let's go back to D2. D2 actually means that You just say D1 is the probability that the option will expire in the morning. But D2 is simply means the expected value of the option at expiry, given that the option is in the morning. So we call it D2. Now, our results so far is good. We have it here as 0.05, which is something we have in our spreadsheet. Okay. Now, next, we have calculated D1 and D2. That's the first part. So we have done this part 1, D1 and D2. Let's go to ND1 and ND2. Now, ND1 and ND2 actually tell us something about the options. ND1 tell us that it's the probability that the price of the stock will change sufficiently to provide a payoff. Then ND2 simply means the probability that the option will be exercised. Okay. Now let us go and calculate both of them. So to find ND1 and ND2, we have found D1 and D2. Let's find ND1 and ND2. The formula for ND2, I'm going to show you here. This is the formula here. I think I explained this more clearly in our presentation. So the formula is num.this x mean, x comma mean comma standard deviation comma and true. Now, actually, what this means that when we are looking for the values of ND1 and ND2 in Excel, we use this in this formula that I just mentioned. The X part of it stand for the D1 and D2. So that we use to get we're gonna get the ND1 using this formula, but here we put D1, the value of D1. To use it to get ND2, we use the same formula, but here we put the value of the D2. So let's go and do it. So we have, so that ND1 equals, you can be looking at this formula here, num.dist. So num this means normal distribution. Okay, num.dist, num.dist. Okay, oh, excuse me, I didn't put the equal sign, that's why. Num.dist, it will show up. Then X for X, we use, this is the ND1. So our X could be the value for D1, comma. Then from the standard normal distribution for your statistics class, you already know that the mean is 0 and the standard deviation is 1. So mean is 0, comma. The standard deviation is 1, comma, and it's true because this is cumulative. Okay. Then close parenthesis and press the enter key. So you give us the value of ND1. Now ND2 do the same thing. Num.dist, num.dist. Oh, excuse me, dist pops up. Double click. For the X, put ND2, comma, mean of 0, and standard deviation of 1, and it's true because it's cumulative. We are looking at from here. Give us this. So now we have this. So then remember, this is part of the formula for value C, ND1 and ND2. So we got this part and got this part. So remember to find P times ND. Now I've gotten all the parts of this formula except E, and which is the exponential, and E to the power R times T. So exponential, like I explained before, you can get by putting equals and ESP. It pops out, double click, and put 1 there. Close the parenthesis. Excuse me. Press enter key, give you the exponential. Now, next is to find E to the power R times T. That means the exponential, put equal sign, click the exponential, raise to the power. Instead, we use the cap key. Raise to the power. This key here, present raise to the power. this symbol here, R times T. And our R is the risk-free rate. For times, we use the asterisk symbol, times T, and our T is time to expiration. Please close the parenthesis, and then press the enter key. That gives you the time. So with this now, we can calculate the value of call. Let us be looking at the formula as we do it. Formula is P times ND1, which we have gotten here. Okay. Then minus, in parentheses, X, which is the strike price over E to the power RT, which we just got here as this, times ND2, which is we already got it. So let us find the value of the call option. Equal. P is the stop price here, times, okay, then ND1, this is our ND1 right here, okay, minus, in parentheses, we got X over RT, E to the power RT, so I'm going to put another parenthesis here. Our S is the strike price, okay. Now, so divided by RT, E to the power RT, this is strike price, okay, good. RT, which is E to the power RT is this one here, close the parenthesis, then times ND2, which is right here, ND2, then close the parenthesis. So when you press the enter key now, it will give us the value of the call option. See, $1.88. This is, remember, this is the price. I mean, the value. This will tell us, make it a dollar sign. This will tell us the value of the call option. What does this number, what does it represent? I will explain to you in a minute. I think I explained it better. Let's go to our PowerPoint to make sure I didn't type the wrong answer there. You can see it right here. So $1.88. So now you can see that in the question, they said that the premium you paid for that option, the option is set at $1.60, which is option premium. Now, the value of the option is bigger than the option premium. So what does it mean? Now, it's basically according to Black-Scholes model, since this $1.88 is bigger than the premium of $1.60, a rational investor might be getting a good deal by purchasing the option at $1.60. Because, like I said, according to the Black-Scholes model, its theoretical value is $1.88. So it means that, for example, what does that difference in the value of the call option, which is bigger than the premium? Well, there's various ways you can interpret this. So usually when the observed market price of a call option differ from the value calculated using the Black-Scholes model, it typically indicates that a situation of the option mispricing. So that means from this previous example, where the desired option premium that you paid was $1.60, and Black-Scholes model calculated the actual value as $1.88. It means that the option was underpriced. The observed option premium of $1.60 is less than the $1.88, which suggests that the option is underpriced in the market. So what does this mean? It means that investors might get a good deal by purchasing the option at $1.60. After calculating the Black-Scholes model, you can buy the option. You know that this option is underpriced. So you can even buy it without even buying the actual option, pay the premium and turn around and then exercise it when it sell the. No, let me put it this way: you buy it, and then the value you're buying, when you buy it, you are buying value. Let me put it that way. So if it is less than this the premium, that means the option is overpriced. There's no point in buying it. Yeah, except if you're buying put option. Okay. So now, another way you can interpret this is this. Since the value is higher than the premium, it is an opportunity for arbitrage. So if you believe that the Black-Scholes model provides a reasonable estimate of the option fair value, and the observed premium is lower, that is, in this case, it is $1.60, while the value is $1.08 of the option is $1.80. It means that this is an arbitrage opportunity. Now, when we say arbitrage, what are we saying? Arbitrage simply means exploiting the pricing discrepancies to make a risk-free profit. Now, that means that we buy the option, you're gonna value go up again. So, or you can even decide not to buy the option, just buy the call, you can even decide to exercise the sell the option, buy it at pay the premium of $1.60, and then short sell the option, call it short sell it at a theoretically fair value of $1.88. So you'll be making 28 cents per share. Now, 28 cents might not sound big to you, but suppose you buy 10,000 of this. That will give you a lot of money. You can make it without even waiting for the option to expire, or which means that let me put it this way, you don't have to take any risk of waiting for it to go up. Just buy the call option at $1.60, sell it, short sell it at $1.88. Make your money. It doesn't concern you whether it expires in the morning or not anymore. You don't have to wait for it. The person that buy it from you can take that risk. Okay. So that is various ways of interpreting this. Let's look at another example of this using Black-Scholes model. And this example, it says equation 2 says it's a Black-Scholes model. It's a use Black-Scholes model to find the price of a call option with the following inputs. Current stock price is $22. Strike price is $20. Time to expiration is 6 months. 6 months is, there are 12 months in a year. So 6 months means 6 over 12, which is 0.5. The risk-free rate is 5%. Standard deviation is 7%. Sorry, it's 0.7. Now, instead of going through all those rigmarole again, that's one good thing about Excel. You don't have to anymore since you have already calculated it here. Okay. All you have to do is to copy this and then paste it somewhere and put the numbers. As we put in it, Excel will automatically be calculating the answers for you. That's a good thing about Excel. So let me just copy this, all of this. So go to where I have question 2 and paste them. Then as we change the numbers, it will be giving us answers, which is right here. Okay. Now, we are given these values. You see that the price of the share is $22, current price. When we go there and put the current price as $22, look at the, as we calculate, I want you to be watching this as we are putting the numbers. Excel will be calculating it for us. So $22, see now it's $1.88. Now when I put $22 for stock price, 22, okay, see, it will calculate. Yeah. So by the time we finish putting our inputs, we already have our answer. That's good thing about Excel. So next one is the exercise price. They said that the exercise price is just the strike price, $20. It's already $20 there, so there's nothing to change here. So it's already $20. Okay. Next thing they told us is that the time to expiration is 6 months. So T is 0.5. We go there and put 0.5. Okay. time is 0.5. So put 0.5 right here. Okay, 0.5. See, it will be calculating it. Calculating everything, including the D1 and D2. Okay, that saves us a lot of time. Next is the standard deviation of the stock is 0.7. Okay, we go and put the standard deviation is 0.7. Standard deviation here, what is it again? Okay, right here is 0.7. 0.7. Okay. So that means we have to recalculate the variance because we put the variance first before we put the standard deviation here. So because of that, it didn't calculate it. It didn't automatically calculate the variance because it came first. So we're gonna recalculate it here. So equals square root of standard deviation squared. Okay, 0.7 raised to the power 2. Okay, that'll give us that. That balances. And then I think we have added all the inputs. We look at let me make sure we have the same result on the PowerPoint. So value of the call option is $5.40. And that is exactly what we have here as $5. We got $5.74. Maybe I typed the wrong answer there, but let me see. I have to make sure. What 9.5? Yes, I have the P over X. Okay, I haven't changed the risk-free rate. Yeah, I didn't change the risk-free rate. Let me see, look at the risk-free rate. That's why. Risk-free rate, it gave us the risk-free rate as 5%. So let's go and put 5% for risk-free rate. 5%. Risk-free rate as 0.05. And then see it will balance $5.40. You can see right here. And that's exactly what I have on our PowerPoint. Okay, $5.40. So what does this mean? You have given the that means the option has it is the strike price. I mean, they didn't tell us the premium. They didn't tell us the option premium, so we can't make any decision here. Because but bottom line is that it's a positive answer. So, but we don't have the option premium, and we cannot say whether it is in the money or out of money at this point. So, well, that is value of the call option. Okay, I'm sure you're having fun by now. All right, let's see. So that's what the answer right here. Now, we did another calculation. Now, let's do one more example. I believe that should be the last example. And then we'll be good. Okay, that will be the last example. Last example says, you have been given, let me say, you have been given the following information for a call option on the stock of MP Care Beverages PLC. The price of the stock is $65. Strike price is $70. Time to expiry time is 0.5. I mean 6 months. The risk-free rate is 5%. Standard deviation is 50%. Okay, it says use Black-Scholes Option Pricing Model to determine the value of the call option. Now, it says suppose there is a put option on MPK beverages stock with exactly the same input as the call option. What is the value of the put option? So to calculate the value of the call option, we get the value of the put option. To calculate the value of the put option, we get the value of the call option first. So let's put these values in. Again, like I told you, since we already calculated it, all we have to do is to copy the formula down to this question 3, paste it there, change the numbers here. As we change it, Excel will calculate it for us. So that makes it our life better. So you can now see why I love Excel a lot, because it make our work easy. So let me copy this and then paste it here in the second example. Okay, value of the call option. So I'm gonna paste it here. Okay. So as we now put the number, remember the answer we had got before for that question 2 is this. Now, as we put the inputs, it will calculate the option for us, value for us. The first input there is the price of the stock, which is $65. So we go and put $65 right there. See, look at the value we have here. As we put the number, it will be changing. $65, 65. Okay. You can see that it have changed to 43. Okay. Now, the strike price, according to the what we have here, is $70. So we go and put $70 for the strike price. $70. Okay. P over X, of course, already calculated it for us, because remember, we did the calculation already in the first question. So everything will be calculated by itself. So our risk-free rate may be, according to the question, is 5%, which is 0.05. And we have it here already as 0.05 risk-free rate, 0.05. Now, next is the we need the time to expire 0.5, time to expire 0.5, which is 6 months. 0.5 is here already. Okay, good. So all these other things have been calculated. Hey, okay. So something happened as I'm recording this. Okay. Yeah, something happened. Technology can be like this sometimes. Next is the next is the variance. Standard deviation is 50. So you go to standard deviation, put 50 right here. 50 for standard deviation, put it right there. So because we added this formula in when we are doing question 2, as we put the standard deviation, it will calculate the variance automatically. 50. Okay. You can see it gives us the answer right here, $65. So we have added all the inputs, and that gives us the value of call option at $65. And this you can see here in our equation here. See $65. So what we got. So that is answered part A. Part B says, suppose there is a put option on NPK beverages stock with exactly the same input as the call option. What is the value of the put? Okay. So now let us go and put value of the puts. I'm going to show you the formula we're going to use for this. So we're going to do it here. The formula for the put option is right here. Value of put option is value of call option plus strike price over e to the power RT minus P. So let's put the value of the put option. We'll be looking at the formula as we calculate it, but I'm going to put it here. Yeah. Okay. So I do the work here. So value of put also put equal sign the value of call option, which is 65, plus this part S over E to the power RT, put it in parentheses. Our strike price X is $70 divided by E to the power RT, which is this one here. Then close the parentheses. Then minus P, which is minus the stock price itself, minus P. And that P is right here. Press the enter key. $68.07, which is what we have here. And that is exactly what we have in our presentation. So this concludes our lecture on Black-Scholes model. I hope you enjoy it. In the next lecture, we'll be looking at the cost of capital. So remember to subscribe so that you get informed each time I have a new lecture available. Thank you for listening, and then I will see you in my next lecture. Have a good night. Sorry, good morning.